A very good afternoon. Let's take a look at the markets. Asian markets were mixed today. This as market players anticipate the start of the central bankers meeting at the U.S. Fed Jackson Hole Symposium. Fed Chair Jerome Powell is expected to speak with investors listening out for any clues around the Fed's stance on monetary policy. The Nikkei share average declined by 0.65%. The Hang Seng Index ended the session down 0.24%, while the Shanghai Composite Index rose by 0.13%. Jude in Wednesday's trade dragged down by the tech counters as investors worried about their lack of profitability. Investors were also digesting the latest Fed minutes from July, which showed that the U.S. central bank is more focused on the inflation level rather than the labor data. The Dow Jones Industrial Average edged up 0.04%. The S&P 500 eased by 0.24%, while the Nasdaq Composite Index declined by 0.67%. Looking at local indicators, we see that the all-share index is currently trading up 0.6% at 101,704 index points. The rand is trading at 17.69 against the US dollar, 20.61 vis-a-vis the euro, and 23.82 against the British pound. On the commodity front, we see that gold is trading at $3,339 an ounce, platinum at $1,321 an ounce, while Brent crude oil is trading at $67.44 a barrel. All right, let's get into conversation now with Mohammed Wagli. He's a portfolio manager at Sasfin Wealth. Thank you so much, Mohammed, for joining us. So why are investors seemingly going off tech stocks now? And just help us understand why investors have been pumping up these stocks all the while when there's a question mark, a fundamental question mark about their ability to make profit.
Hey, Nompu. So always a pleasure to be on the show. And yeah, very topical question. You know, it's not sort of the first time that we've seen sort of questions around an AI bubble. But I think with reference to what's been going on in the past couple of weeks or so, there were a couple of headlines that came out. First was a study from MIT that came out, and I think this was yesterday, and it said something along the lines of 95% of companies see no return from generative AI. And then sort of just to compound that, we got some headlines from the CEO of OpenAI, of course, the progenitor of ChatGPT, and Mr. Altman, the CEO, was warning of a potential bubble. And I think, you know, those things sort of compounded on each other. I think what he did really was to draw parallels between this and the dot-com bubble in the early 2000s. But look, I think it's a little bit different. And what I will say is that, look, we haven't seen massive direct sort of AI returns from things like generative AI. But what's a little bit more difficult to quantify is operational efficiency. You know, the costs that have been sort of cut in that respect. And maybe it's not sort of as glamorous, but I think this idea that we haven't seen sort of any improvement at all from AI thus far is a bit misleading. You know, perhaps we haven't seen stuff in maybe more direct AI related things like your generative AIs, but that doesn't mean that it's not sort of going to come, you know. And in terms of why the market's been punting it, you know, there's still massive application here. There's still sort of massive growth that is being priced in. And you know, personally speaking, I don't see this technology going away anytime soon. You know, I'll often enough ask colleagues or friends, you know, if you had to pay for this service, you know, assuming you had to pay for it and there was no other choice, you know, how many of you are likely to pay for it? And almost without exception, you know, 2 years later from ChatGPT, it's something that, you know, most of us can't live without already. So personally, I do think the application is there. And I will just make a point in relation to Mr. Altman's comments. You know, he did mention that, look, the market is overexcited about AI, but he's also of the belief that the long-term trend, the long-term sort of outcome is going to outweigh the sort of froth that we're seeing currently, you know. And to that extent, he's still throwing the kitchen sink at AI, you know, in pursuit of that goal. So to sum it up, I do think that they were maybe taken a little bit out of context with those comments, but ultimately still feel the practical application is there. We're seeing a bit of a sort of come off, but make no mistake, those investors will be back in these tech companies soon enough.
Okay. So what was your reading of the latest Fed minutes? I mean, is the market still pegging quite a high probability of a cut in September?
Yes, a very high probability. And I don't think that there should actually be this level of consensus given sort of the rhetoric that is coming out of the Federal Reserve. I imagine, and you mentioned this earlier, we'll probably get a bit more information tomorrow from Mr. Powell, who's speaking at the Jackson Hole Symposium. But, with reference to those meeting minutes, I think they were in focus because at the previous meeting where the Federal Reserve held rates steady, it wasn't actually a unanimous decision. There were two sort of dissenting votes that wanted to cut. And I think investors were keen to sort of see, how that argument went. And, truthfully, it was quite, logical. Essentially, you've got majority of the Fed that still see massive risk to the upside in relation to inflation, and that is the priority. And then a small minority there, those sort of two dissenting voters, were quite concerned about the weakening employment. Now, of course, the Federal Reserve's mandate is to conduct monetary policy in a way that promotes maximum employment and price stability. So those are two things that they are mandated to do. And it just seems that price stability, the inflation, is really what is being emphasized now. So in terms of overtly saying that we're going to get a rate cut in September, there was nothing like that, not even sort of close to that. I think it very much remains that they're going to be sort of data driven. It's just that a small minority now seems to be focusing a little bit more on the labor market, but the vast majority still seem to be worrying about inflation. So interestingly enough, market's still pricing in that, a near consensus that there's going to be a rate cut, but I think September will be a little bit more contentious than that. So let's see how it plays out, but hopefully we'll get a bit more guidance a little bit later tomorrow.
Well, in 60 seconds, perhaps you can respond to this. What are your expectations from the Reserve Bank, given that we saw that jump in inflation of 3.5% for July?
So personally, I'm not sort of as bullish maybe as a lot of my colleagues are, and I think a large part of that is that they're looking at this very much from the context of the long term. Those CPI numbers came in a little bit softer, and I think people are hoping for sort of a knee-jerk reaction for a little bit of relief. Those rate cuts put actual sort of money in the bank account. So it would be ideal if that was to be the case, but I think they're going to be looking at this from a long-term perspective. We want to keep that rate as close to 3% in the long term. So that's sort of the context that's going to be dictating how they think about this. Personally, I think it's unlikely that we'll get another one anytime soon. But even if we do, I don't think, we're like sort of halfway through a cycle. I think there may just be one more, and that's it, at least for the foreseeable future.
All right, Mohammed, thank you so much for your time and insights. As always, Mohammed Wakli is a portfolio manager at Sasfin Wealth.